The everything bubble has become very large. It may pop soon. Then again, it may not. In this video, I'll present evidence showing that there is a large asset price bubble. I'll discuss what has caused this bubble, explain my current investment strategy, and tell you why my strategy might be completely wrong for you. Let's start with the CAPE ratio. Robert Shiller's CAPE ratio, the cyclically adjusted price-to-earnings ratio, measures how expensive the stock market is by comparing current prices to average inflation-adjusted earnings over the past 10 years. It shows that U.S. equity valuations are now extremely elevated by historical standards. The CAPE ratio is now 39.5. That's the second highest it's ever been. The all-time peak was at the top of the dot-com bubble in December 1999 when it hit 44.2. The current level, 39.5, is significantly higher than in September 1929, just before the Great Crash, when it was 32.6. So this is telling us that valuations are extremely high. The Buffett Indicator is also showing extreme overvaluation. It measures the ratio of total market capitalization to GDP. In 2001, Warren Buffett told Fortune magazine, "The ratio of total market capitalization to GDP is probably the best single measure of where valuations stand at any given moment. If the percentage relationship falls to the 70 or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and as it does now, you are playing with fire." It's currently 225%. It's all-time high. So if Buffett's right, this means investors are playing with fire. The wealth-to-income ratio is also extremely stretched, indicating that asset prices are highly vulnerable to a sharp correction. This wealth-to-income ratio is measured by taking household sector net worth divided by disposable personal income, wealth to income. This chart goes back to 1952, and the average for this ratio since then has been 560%. Currently, it is 780%, far above the peak of the dot-com bubble when it was 615%, and very far above the property bubble when it was 675%. So this is another indication of overvaluation. Next, NVIDIA's market capitalization at $4.8 trillion is larger than Germany's GDP, $4.7 trillion. This means the value of NVIDIA is greater than the value of everything that will be produced in Germany this year. Apple and Microsoft have market caps larger than the GDP of France. At the peak of the dot-com bubble, Microsoft's market cap was equivalent to 6% of US GDP. Cisco Systems was 5% of GDP. At the time, I thought those valuations were crazy. Today, Microsoft's market cap is 12.5% of US GDP. NVIDIA's is nearly 16% of GDP. When the dot-com bubble popped, it took 16 years for Microsoft's share price to return to its peak level. Cisco's share price still hasn't returned to its dot-com peak. Finally, in recent weeks, there has been a chorus of warnings from international institutions and business leaders that asset prices are stretched and at risk of a significant correction. In its October Global Financial Stability Report, the IMF flagged that valuation models show risk asset prices well above fundamentals, raising the risk of sharp corrections. On October 8th, the Bank of England warned the risk of a sharp market correction has increased.